Hey there, everybody. Welcome back to 21st Century Renaissance and another open interest newsletter breakdown on GameStop. I'm your host, Dr. Michael LoPiano. It is Thursday. It is the day after FOMC. It is more than one day now after Bank of Japan. And indeed, what we talked about yesterday, this opportunity for a golden window for GameStop is indeed in place. At least that's the way it looks from here, coming up over the next couple of months. So we're going to take some time to continue to break this down and sort of digest what the Fed's announcements, what Powell's announcements yesterday mean for us going ahead, why that's going to be important for GameStop, and some potential deeper bullishness going into the next couple of months, going into really possibly even into June OPEX. So we'll think about that a little bit, and as well as break down our daily indicators and think about what the next few days will look like going into the end of this week and going into earnings. So that's what we're going to talk about today. Let's see, as always, before we get into our discussion, let me do this first so you can see. Right, gratitude first goes out, right? Can't speak highly enough of Fervent Coffee, right? This is from Keith and Tabitha, who have been longtime followers of the channel going all the way back to our Reddit days. Right, they met through a shared passion for coffee and decided to send me some of their most delicious beans from their roastery out in Colorado. So definitely give Fervent Coffee a check out. Right, the link's down in the description of this video. And then a big shout out goes to, as always, our monthly contributors, Dad Scruffto, Ken Wedmerland, who help offset some of my data expenses, as well as to Kurt Lusko, otherwise known as Short Fridays, always enthusiastic participant in our weekly live streams, which we do have coming up this Friday at 4 p.m. After market close. So look forward to seeing you all there. We're going to think a little bit more about earnings this week, as well as review some of these potential ETF settlement factors, swap rolling factors, how these relate to one another, and what we might expect into April, into May, and maybe even into June OPEX. So taking more of a quarterly outlook there. Look forward to seeing you all there. Viewable both on YouTube and on Twitter. So looking forward to that. Okay, so let's get into our discussion here with respect to FOMC, right, and Bank of Japan, right? So yesterday we took some time to talk about the implications of the Bank of Japan decision not to raise interest rates. We took time to think about and break down the yen carry trade, exactly how that works, what the stakes are, and why, say, the Bank of Japan raising interest rates by 0.25%, why would that matter, results in a decline, often a decline, or has recently often in these steep declines in U.S. equities. So that seems to be the case. What I've been largely hypothesizing has been, right, despite this kind of the deep seek dip, or the dip regarding tariffs. Dip regarding tariffs doesn't make sense to me, and specifically, right, the reason why is exactly what the Fed came out and said today. In fact, right, the Fed came out, or I should say yesterday, came out and said higher inflation amid Trump uncertainties with respect to tariffs, right? So the concern here is that tariffs might result somehow. I'm not exactly sure how this would work, but that tariffs may delay inflation progress. So that tariffs, to a certain extent, well, I suppose I do, right? The thought there is, right, so with currency, right, if you do not have a growth of goods, a growth of value in the economy with respect to the money you print, you experience price inflation for ordinary goods, right? So the Federal Reserve Bank targets a certain percentage of currency growth, because the idea is if you have more value in the economy, right, you want to keep the currency supply. You want the exchange of goods and services to remain liquid. You want prices not to be volatile. You'd like them to remain consistent, steady, and you want participants to be to have confidence in various goods and service markets. Right? Volatility does not typically encourage confidence in those markets. If you have really volatile price action, that tends to keep people who tend to be risk averse from participating in those markets. So you want to have a low level or a level of inflation that of the currency that matches to a certain extent, right? That matches the growth of the economy so that you can preserve liquidity in various markets for goods and services and keep the volatility in those markets down, therefore encouraging more participants. And the more participants you have, the more goods and services you can have, right? The economy grows, the more exchange you have, right? Et cetera, et cetera, et cetera. Okay. The United States of America has, over the past 70 to 80 years, secured a position in the global economy where it has essentially turned almost the entire world into its own personal and currency underpinned global market, right? So without getting too much into this is something I would often actually discuss with my history students back when I was teaching basically introduction to Western Civ and to early modern and modern Europe, right? Or modern world, I should say. Western Europe, Western civilization especially, is this idea of markets, right? And part of the idea of building an empire, right? What basically set the standard or established the status quo for the 16th, 17th, 18th, 19th centuries, maybe less so the 16th, but 17th, 18th, 19th centuries was the establishment of empires, right? And empires, we think, well, it's just about dominating people. It's just about having people under your control. But really, right, what the building of, say, a colonial empire in the 19th century, 18th or 19th century was about bringing territories into your commercial sphere, right? Being able to conduct trade with them, having them use your currency, having them in certain respects as well, pay your customs dues, right? And they pay your customs, they pay taxes, import fees, export fees, whatnot. They offer labor into your labor market, right? This is why India was in part so important to the British Empire. It was this massive labor market, whereas Britain does not have a very large population, but India's population, massive, right? They can grow food themselves, but then you can use them for labor for your own products, especially if you are importing goods from, say, the East Indies, right? From places like Indonesia, things like this, right? You also have trade goods in this area, but okay, labor market, right? You can use places like China, right? Why are Hong Kong, why Shanghai, why are these places so important? Well, because China can be used as a massive export market, right? This was done, for example, during, was the cause of the Opium Wars, right? Opium was being produced due to British control of the territory around part of Afghanistan, and large amounts of opium were being produced, and the British wanted a place to export this, right? Parts of the British Empire wanted to export this, and so forced China to be an export market for this opium, right? So part of the building of empires is you can cobble together, right, this sphere of influence that allows you to essentially extend your economy and your financial sphere, your financial influence, right? You kind of grow your economy, and if you sit on top of the financial, let's say, sinews of that commercial sphere, that economic sphere, well, you can grow extremely rich. And then as a result of that, everybody ends up speaking your language so that you can travel anywhere in your sphere. And so this was really the competition of empires in the 18th and especially 19th centuries. Well, America ended up benefiting from, right? So, well, first let me say the British Empire essentially established the most wide-reaching hegemony going into the 20th century. France was close behind it, but it was really the British Empire, whereas the United States largely stuck to the Western Hemisphere, right? Largely stuck to its own boundaries because the United States already has, right? It has everything it needs domestically. U.S. doesn't really need to import stuff. It certainly didn't in the 19th century. Doesn't lack for food. It's got great natural, interior ability to transport goods and services around. Huge ability to industrialize. And the thing about the U.S. is you don't have to go look for people elsewhere. Everybody wants to come everybody wants to come there, right? So you have a growing labor market from immigration, right? So you have one generation of immigrants comes in, those immigrants end up serving in roles perhaps that older generations of Americans do not necessarily want to. They go through one generation, say, of working in the mines or doing kind of lower skilled labor. Their children then become educated. They found businesses, and then up you go, right? Something like that. And so then you can do this with each successive generation. Your population is simultaneously growing. People are having children. Your economy is burgeoning. You don't need to go out and do this. Okay. The United States changed its tune on this following the Second World War and essentially picked up the remnants of the British Empire, replaced the British pound as the national, as the world reserve currency, made the US dollar the world currency, and then attempted to essentially make the entire world a US dependent global market for goods and services. Okay, so inflation with tariffs, right? How could tariffs play into inflation? Doesn't the Fed just print money? Like, what's going on there? Okay. Well, the idea is if you are issuing tariffs, the US has been able to do this essentially under a global free trade system. So the US system is, look, we will never charge duties, we will never charge customs, we'll never do tariffs, never going to do this. You have everybody, if you have your currency, or excuse me, if our currency underpins your currency and you trade on our system, you get to use the United States as an unlimited free import market. And by the way, also, we will fit the entire bill of protecting the sea lanes because we're the only one that's going to have a fleet. So you can take, instead of developing your military, instead of developing anything beyond your basic defense capacity, you can use our missile shield. So anybody else who's got nukes or anything like that can't threaten you. We'll put military bases in your country. So we'll have our ground troops come and basically man your border. Exempli gratia South Korea, exempli gratia Japan, exempli gratia now recently, right, Poland, exempli gratia the Baltic states, right? Okay, falling under the U.S. missile shield. And right before that, right, Germany, France, Italy to a certain extent, right? All of this, Turkey. This is what's been the case. Australia, right? Okay. So then on top of that, right, the U.S. Navy is larger by a factor of 3 than all of the rest of the world's navies combined. So the United States, you don't have to spend any of your money on that. You don't have to spend it basically on outfitting an army. You don't have to spend your money, right? You spend a token amount, and that's kind of the NATO thing, right? You spend a token amount on this stuff, but really the U.S. is fitting the bill. So the U.S. takes care of everything you need to protect your shipping lanes, right? Keep in mind, right, what's going on, like right now with these pirates in the Horn of Africa. Whoever, like Brazil is not sending its navy out into the Horn of Africa to go protect its trade interests. It's the U.S. The U.S. shows up with its carrier group, right? Marco Rubio is like, we're going to go launch strikes on the Houthi pirates in the Gulf of Hejaz. It's like in the Red Sea. It's going to be that, right? It's not, as much as we might like Javier Milei's economic dynamism. Argentina's got no navy to do anything about that. It's entirely dependent on the United States in order to protect its overseas shipping lanes. Okay, so the U.S. takes care of all of that. Now you, oh country, who is essentially using a currency pegged to our currency, whose interest rate and inflation rate and everything our federal bank controls, our Federal Reserve Bank controls. But now you get to use all of your defense spending and just plow it into the economy or any other types of purchasing things you might want to do, right? If you want to, this allows, right? I guess, I suppose, if you want to take part of your defense budget and stick it in your pocket, who are we to say otherwise, right? Something like that. So why would tariffs affect that? Well, if you think about this, right, technically the U.S. economy is not just what the U.S. measures in terms of its official GDP, right? Because the U.S. labor market extends well beyond its borders. It's part of the U.S. labor market is in China. Part of the U.S. labor market is in Thailand. Part of the U.S. labor market is in, Lesotho, right? It's all over the place. So, and these currencies, like the Thai baht, for example, it's just in Thailand. The Thai currency is pegged to the U.S. dollar. It is a U.S. dollar dependent currency. So in effect, right, the United States has a sphere of influence that reaches into many of these other countries. You're not looking at a US labor market that's the US population, 300 some odd million people. It's a labor market of billions of people, and it's a goods and services economy of billions of people. So, even when something's going on in Thailand, Thailand's got their own government and they do whatever, there are transactions that are occurring between Thai people that are essentially economic products. They are like second order derivatives of the US economy. They are plugged into the US economy. Different, say, than something like Turkmenistan, where they've got their own currency, they do their own stuff out there. The US is not involved at all. That's different, right? Those are economic transactions that are isolated, essentially, or are more degrees of derivation removed from the US economy. So with tariffs, what you do, and the idea here is, as soon as you start imposing tariffs, you're going to have some of these economic transactions, move out of these countries. Or the idea is you're going to shrink the labor market. You're going to, reduce the willingness of foreign entities to participate within the U.S. Economic zone or sphere of influence, to use this 19th century, colonial empire terminology. It's not the same. It's not the same system. But to use some familiar terminology. Okay, so what's that going to do? Well, unless the United States plans to decrease the total amount of currency that's in circulation, what you're doing is you're going to have inverse inflation, right? So the currency is going to stay the same, but you're going to remove goods and services from the economy, right? We're used to quantitative easing. Quantitative easing is the goods and services of the economy remain the same. The value stays the same, but currency goes up. So prices go up with it because you've devalued the dollar. Okay. The concern here with tariffs is that if you remove value from the US economy, right? So you're decreasing the value by shrinking the de facto US economy, which is maybe a 4 billion has a 4 billion person labor market or something like that extends, all over the Pacific and Atlantic Oceans, something like that. Okay. So if you're decreasing the value, if you have countries basically that are saying, well, we're just not going to do business in the US anymore, or US companies that aren't going to draw on that labor market or that materials market or something like that, that outsourced market, well, then you're reducing the participants, you're reducing the net value, but the currency is staying the same. So the net effect of that is like quantitative easing. You're just decreasing the value that's encompassed by the US dollar. That's actually that's the same kind of concern with like the BRICS nations or something like that. If they unplug from the US dollar, the concern with Saudi Arabia and coming off the petrodollar, using the dollar as the medium of exchange for oil, right? Essentially the entire oil market is underpinned by the U.S. financial system. So in any case, right? So that's the concern there. And what we see here with what the Fed is saying is, all right, well, if these tariffs are going to start to come into place, it may not result in something like runaway inflation, but it's going to slow our own progress on reducing inflation, which is reducing the rate of inflation. It may remain higher for longer. Okay, so what does that have to do with the broader market? What does that have to do with this, this golden window for GameStop? Well, if inflation remains higher for longer, then equities pricing, right? The appeal of equities is going to remain higher for longer because inflation corresponds to increases in equities prices, right? So the prices of everything go up, but if your money is in equities, it's going to go up the most proportionately to or with the, I guess, closest correlation for inflation, right? We talked about this yesterday. SPY essentially tracks real inflation, or more closely approximates real inflation. If you use the 1980 metrics on inflation from 1980 to today, or from 2023, and you track the same amount of appreciation in SPY, the numbers are identical. The net composite appreciation, or let's say the depreciation of the dollar versus appreciation of SPY, are exactly inverse to one another, the percentages. So, right, you're looking, I think it's something like you have like 4,390 something is total inflation, and the appreciation of SPY is like 20 percentage points higher than that, like 400, 419 or something like that. So the idea there is if you're seeing inflation, and right, this is how, like, I looked at, right, I was doing my graduate work at Yale. I was finishing up my PhD a few years back during COVID, and I saw how, their endowment just went nuts. And I was like, man, how did these guys make like 44% on their endowment? How did all these universities just make billions and billions of dollars on their endowment? Well, first off, their financial departments are run by people with Wall Street experience who know that, oh, all right, Fed just comes out and says we're going to double the money supply. We're going to pursue this policy of just printing money. We're going to, I think that the M2 money supply increased by like 280% between 2020 and 2022. So like, yeah, in 2020 to 2022, half of the dollars in circulation currently were printed, half of them in that 2-year period. So if you see that, right, if you know about this relationship between inflation and equities prices, equities are just going to pump. So what happened, right? We had the COVID dip because everybody panicked, but then quantitative easing comes out and it's like, oh, okay, well, we're going to expand the money. We're going to double the money supply in the next 2 years and give everybody free checks. Okay, plow your money into that dip, that equities dip, the dip in the market, because not only is it going to recover, but now what you're saying is the absolute value of the market, it should double in the next couple of years as price discovery occurs. Now, sure, the prices of everything else are also going to double eventually, but this is essentially how you protect your investments and your earnings and stuff from what's going on there, right? And you can do your little financial tricks to to preserve capital, something like that. Okay, so what does this mean? Well, if inflation is going to stay higher for longer, it means that not only do we not have interest rates affecting the deleveraging of the yen carry trade, but equities prices are going to, there's suggestion here that because inflation is going to remain higher, equities prices are going to remain higher for longer. Okay, why does that matter for GameStop? Well, this likely means that in the broader market, we are looking at something of a mild recovery. Maybe we don't go back to all-time highs. Maybe we do. It depends how bullishly this is interpreted. What goes on with tariffs, I don't know if those really come into effect in the next couple of weeks, what that'll mean. But yeah, we might get something of a mild recovery, or at least some stability in this range for the next couple months in the upper 500s. Maybe we cross over the 600 line. Not sure. We're looking at our daily technicals here. Looks like we could see a move back into the 590s, just as we anticipated that this current move that we saw prior to March OPEX would kind of top out in the 570s, since that's where we have our 200-day moving average sitting. So, right, why would that be meaningful for GameStop? Well, as we talked about yesterday, when SPY is moving down, right, when the broader market is in distress, when we see deleveraging, GameStop also takes a big hit, and that has to do with the ability of institutions to draw upon synthetic short liquidity from ETFs without risking the integrity of their margin balances, right? If you open up a short position on an ETF, if you're shorting an ETF and the ETF is going down, you're making profit, right? The value of your position, your short position, is increasing, which is helping your margin balance while the price is going down. If you're attempting to adjust GameStop's price down by shorting the underlying ETF, but the underlying ETF and the broader market are moving up, your short position is losing value and you are taking a hit to the stability of your margin balance. If we return into these stable conditions, and we've seen this take place over the last couple of days, in fact, we saw this take place during yesterday's trading. We had a very stable day in the market, and what happened? GameStop's price action decoupled from what was going on, right? We see very close correlation between the overall price movement archetype of GameStop intraday and what occurs in the broader market when SPY is moving down. And the more aggressively it moves down, the more the price archetype, the intraday price archetype on SPY corresponds, matches up, is similar to what we see over in GameStop. Now that we're moving up, we see stability. GameStop price archetype is decoupled. It's not doing the same thing, right? Here's GameStop, right? Looks very different from what we saw in SPY, right? It did not look like this. This is different. Obviously, right, this was largely influenced by FOMC, but when we see these bullish days, we get a decoupling. Some correspondence here with what was going on with FOMC, this little bit right here. But yeah, as Ultimated pointed out, what we saw early in the day was a pretty close correspondence with ETH. So with Ethereum at the beginning of the day, represented this pretty big pop here. Ultimator's been talking about how it's very likely that GME and Ethereum are swapped, or they're not swapped with one another, but that they are potentially in the same sort of swap. That may explain why the GME Bitcoin connection is so hyped, something like that. Yeah, so what this means is that over the next couple of months, if this does in fact, as I think it will, translate to price stability and some bullish recovery, possibly up to this 590 area in SPY over the next couple months, 1 to 2 months, we have a window where GameStop is not necessarily at the same risk, right? One of the key tools of suppressing GameStop's price is taken away from institutions that would want to do so. Now, we had a lot of FTDs, as we've seen. Richard's been pointing this out. We had a ton of FTDs on XRT, IWM, IWB that were incurred in mid-February, right? So if we pop over to our GameStop chart over on TradingView here, right? Let's see. I want to do this. If we pop over to our chart on GameStop, whoops. How do I get the... Oh, man. There we go. That's what I want. If we hop over to our chart here on GameStop, we can see, right? We can see some of these moves, right? So this particular move in here, during this period, late February, this move that took us off of this big rip, actually this went all the way up to 31.66, right up here, this move. And then magically the price teleported its way over a few days, all the way back down sub 25, where we traded 24.25 for about a week before this big move, and the swap rolls in this area. So how did this happen? Well, we can see now that we have FTD data for these major funds. So XRT, IWM, IWB, millions of fails to deliver right in this cluster, right around the 21st, between the 18th and the 21st, this week here, where then afterwards we began our continued move down, despite the fact that we started to recover from our January FTDs. So these GameStop fails, right, or shorting that clearly took place on GameStop here, was likely cleared around the 14th of February and then re-entered by juggling some of these fails, right, juggling them. Some of them were closed, but then re-entered via these other funds in the subsequent trading days after this recovery. And so we're still waiting. Essentially, we're waiting for those shares to be cleared, right? And they will have to be cleared sometime in early April, likely. So we have some more swaps. We have swaps expiring, tens of billions. I think it's close to $40 billion notional value in swaps expiring next week. And we will be, but potentially once those are done, once those are gone, there will be a window where we will be looking at some FTD clearing. If this should coincide with some potential, wombo combo action, something perhaps from, maybe Maureen Kitty, maybe Ryan Cohen. Now there's some things being teased with Sultan Al-Madid of Qatar. If something occurs in this range, right, if we start to move up, then move back down, but then as these FTDs clear, we start to move back into our upper 27s, we get that wombo combo again. Maybe we have another chance. We have the right context in the broader market here in April, May, prior to new decisions from the Bank of Japan and from FOMC, from the Federal Reserve Bank, that we could see another big move. We could see another attempt here to start a kind of chain reaction and get GameStop moving back to the upside before we get our June earnings debut back at the beginning of Q1 earnings at the beginning of June. So this is the golden opportunity that we're talking about. It does look like we're going to have the right context. Now, if something, right, we have, let's say a settlement, right, a structural catalyst, one or more structural catalysts based on these FTDs coming up at the beginning of April. If we can get something from the company as well, if we can get something, right, if we see something from Cohen, from Kitty, maybe from Sultan Al-Madid, whatever it is, if we get this coming in as well, we get a company catalyst to join with the right contextual factors and the right mechanical catalysts, which we know are coming down the horn. This can result in something like the move we saw take place last November. To speculate even before this, last April, right, we had volume conditions, we had low liquidity conditions, which it's the only time I could find where we had low liquidity conditions like what we're seeing now. So very, very low share count traded, right, under 3 straight days under 3 million. We had essentially back here on Tuesday, we had the lowest, I think, so at the market, post split and post at the market offering adjusted trading. This was the lowest volume day in GameStop pretty much ever, at least in the past 10 years. So very interesting to take a peek at that. Now, what I will say in the short term here, thinking about what's going on heading into earnings, right? I'm going to call this out first, and it's that we have a lot of shares available to borrow. Even if we see a move up, this is enough direct shorting. There is enough liquidity for direct shorting to very easily walk the price down several dollars. If we see a move up, this may be right into earnings, say on Friday, maybe into Monday. Likely Monday is, I think, at this point the best candidate, but something could happen Friday. If we see a move up into $25, right, that's, maybe earnings will be great and we'll kind of blow through 25. Well, maybe, but this can be walked down. There is the firepower to drag this down and keep the price kind of contained. And of course, the options market maker, Wolverine Trading, based on our current max pain values, is not especially incentivized to allow the price to move past that $25 call wall, right? $25 is now, according to our gamma exposure data, is now our call wall. That's our largest position of market maker net call exposure. The market maker is not going to want to allow that position to close in the money if possible. If the market maker can afford that, their profitability is going to be much better if that closes next week out of the money, and the following week as well for them. So we have to be careful. What I think maybe something like this could occur, right? We kind of stick at the 23.50 into the end of this week. Maybe Monday we shoot up to 25 and then get maybe shorted down as a result of earnings, no matter how good it is. And part of that is based on what we know about swaps, right? We have swaps expiring on the 28th, so next Friday, and the 31st. So that would be the following Monday. If those are short swaps, whatever institution has those open is also going to want to see those get marked if they're going to get rolled, or even if they're going to be closed, rolled or closed at the best right average price possible. If it's a short swap, that's going to mean lower, right? IV trends, right? We still see this pattern where our mean IV is going up, but Schwab's composite instantaneous IV is going down. This is what I'm looking at here. This has been somewhat different than what we've seen. I would say Q3 earnings were a little bit like this, where we had so much action going around in the background, it was difficult to actually figure out if we had an earnings effect going on because we were so upwardly volatile that that was a stronger factor than the earnings IV itself. What this suggests, right, where we see here 10-day mean IV is going up like this, this suggests to me that yes, there is that earnings appreciation effect in the background. If we didn't have it, we'd probably be looking at IV like in the 50s, something like that, right? 56, it'd be like an all-time low or something like that, or a recent low. It'd be a 52-week low in IV if it were not for this earnings appreciation effect. And what we see, right, if we take a look at our individual weeks, we can actually see that the weeks approaching earnings and just coming after earnings, so the ones clustered around here, do have elevated IV numbers, right? So earnings week, IV is at 120% almost. So that's up. But because of our price action, because this price action being so low is not typical, we haven't seen this so low approaching an earnings period. Certainly at no earnings period last year did we see such low volume, right? You think Q1 earnings was amid Roaring Kitty's return, 2x. Q2 earnings, we had like two big weekly like gamma ramp runs that likely occurred amid some FTD settlement that had to do potentially with Chewy as well. Q3 earnings obviously happened smack dab in the middle of that November-December run. So volume was up then. Now, not so much. We're not seeing volume elevated. So what that's doing is farther out expiries that are typically not affected by the earnings appreciation effect on IV are slumping down based on how our price action and total volume is playing out, whereas the near ones, although they are affected by that low volume, they do have that IV effect incorporated into the earnings IV effect. So this may be lulling some traders into believing that IV is lower than it is, but we might see if the price drops, right? We will probably likely see in these expiries something of an IV crush once the earnings catalyst is actually passed, even if it's bullish. I mean, if it's bullish enough, we might get enough introduction of IV into the stock to offset some of this. But I would say it's probably something like, based on these values, how this is set up, IV is high here for, say, the 28th and the 4th. That's very high, even the 11th. So it may be that institutions or market makers are drawing in purchasing, right? So like something like seeing our overall composite value as relatively low, they think, oh, okay, are they going to pump it? Are they going to pump it after earnings? And then people come in and they buy short dated options, which are really pricey. Then they drop it, those get out of the money, they sell for a loss. But then others perhaps, right, who think, oh, well, it's going to drop. Well, I want to take advantage of as much value as I can. So I'll sell them further out. I'll sell April OPEX. But April OPEX or after April OPEX, that IV is low. So they'll drop it immediately afterward. These options will get crushed by, 20, 30, IV will go down 20, 30% after earnings. These will take a loss. But then these, even if the price doesn't drop, right? If we go up, right? A couple dollars, right? This will mean if volume goes up, these IVs will appreciate. So anybody who sold short options into this might take a hit, and anybody who bought long options into these expiries will take a hit. So, something like that, market maker could win both ways, especially if that market maker knows that some kind of a bigger move is happening, or stands to happen, could happen farther out in April. So, right, this is speculation on my part. I don't know exactly what strategy they're adopting here, but this is sort of, I think this explains essentially, right, there is a background earnings effect that's going on, but because our volume is so low, that's not being affected at later options expiries, whereas the composite IV typically in previous earnings periods has been higher as a result of increased volume that usually, well, at least over the past year, has attended our trading around earnings. So I think that's what's going on. Obviously, we're still pretty excited for earnings. The 25th, 25th is going to be an interesting day. 26th should be a good earnings for GameStop. Not sure if anything big is actually going to come down the pipe, but definitely very encouraging to see what we've seen here in our broader market context. I think this isn't sealing the deal on, hey, we're gonna go to the moon in April or June or something like that, but this is certainly an important step. This is certainly an important contextual dimension to have in place if we are going to see something like that, if bigger players are going to end up pulling something like that off. So so exciting stuff. Looking forward to seeing how our trading plays out today. Probably going to be, again, on the lower volume side. Maybe if SPY, right? I think if we do see some corresponding action in SPY, if we do see something like SPY breaking that 570 boundary, I could see maybe a little bit like a move in GameStop up into the 24s. But I still think, I think market makers are probably going to try to aim for something close to a max pain finish. There's not a ton of, it's at 2350, but there's not a ton of call OI around 2350. So what are we looking at actually? Yeah, in these prices, kind of in the upper 23s, around 24, we're pretty close to that kind of golden out of the money call ratio on GameStop. So I could see another week of that heading into March OPEX, maybe a little bit more dynamism beginning of next week going into earnings, then a little bit of disappointment, a little bit of crush, maybe for those swap rolls, and then and then it's time to see what's going to happen with those FTDs, huh? So we'll continue to monitor this. We'll be back at this with another analysis tomorrow, Friday, and then of course, as a reminder, 4 p.m. Eastern time tomorrow, we have our weekly live stream. We'll do some more thinking about this, and have plenty of time for questions as well. So thank you guys as well as always for watching and listening, for supporting. Once again, to keep Tabitha for their delicious coffee beans, and we'll